When the market drops, most people get nervous, okay? And that's completely normal. But here's the question I want you to start asking yourself the next time it happens. It's how can I use this as an opportunity, all right? Because that shift from worry to strategy is really what separates the people who build long-term financial independence from the people who really just ride the market and hope for the best. Okay. Asking yourself that question also helps reframe a little bit of the emotions that you may be feeling when the market comes down. Again, by shifting it really from worry to strategy. Okay. So with that said, one strategy worth considering when the market is down is a Roth conversion. All right. And today, what I want to do is walk you through exactly why that is using real numbers. Okay. So, but before we get into the math, let me set the assumptions so everything that follows makes sense. Okay, so now we're assuming we're converting shares directly here. So we're not selling your investments to generate cash first. Okay, we're converting the actual position. All right. Now the taxes on the conversion are paid separately out of pocket from money outside of the IRA. Okay. And then for this illustration, we're assuming a fixed growth rate of 8% annually over a period of 25 years. Okay. Now, the 8% is a hypothetical number used to make the math clear and comparable. It's not a prediction of what your investments will actually do. Okay. It's not based on any specific investment or index. The actual returns may vary, they can be higher, lower, or negative in any given year. Okay. So I'll say more about that at the end, but that's the setup. Now, here's why that the market level at the time of the conversion matters so much is because when you do a Roth conversion, you pay tax on whatever that position is worth at the time of the conversion. So if the market is up, you're paying taxes on a higher value. If the market is down, you're paying taxes on a lower value. Okay. So in this illustration, the investment still grows at 8% either way. All right. Either way, it's grown 8%. The potential recovery happens inside of your Roth. Okay. So being that it's a tax free account, and assuming tax laws remain as they are today, you'll have that tax deferred growth with tax-free withdrawals down the line. So in this scenario, you're paying less to get the same projected result. Okay, so that's the opportunity we're looking at. All right. Now let's put numbers in to put it in perspective here. So we'll look at three conversion amounts. So we're going to look at 1,000, 5,000, and 10,000. Okay. Now for each one, we'll compare converting at market peak versus converting when the market's down. And we're going to say 20% when the market's down 20%. All right. And then we assume that your tax bracket is 24%. All right. And again, remember the growth rate here we're assuming is 8%. And we're just spreading for this example over a period of 25 years. Okay. And again, that's our hypothetical assumption for the illustration purposes. Now, starting with 1,000, okay, if we were to convert that at the peak, the position is worth $1,000, okay? So the tax bill at 24%, that's going to be, you do the math, it's going to be $240. So using our illustrative assumption, okay, that $1,000 grows inside of your Roth for 25 years and reaches approximately $6,848. Okay. That's the math, not shown there on screen. But now, if you were to convert when the market is down, so when the market's say 20%, all right, that same position is now worth $800. Okay, so the tax bill drops to $192. So you just saved $48 in taxes on that conversion. All right. Now, again, if the market recovers and that position grows at that 8% that we were suspecting for 25 years, your projected Roth ending value will be the same. okay? Because we're using that original amount, assuming that we didn't hold back taxes, okay? So again, it's going to grow to that $6,848, okay? So the potential ending value is similar under both scenarios in this illustration. Illustration, the tax bill's lower. The only difference is when you pulled the trigger. Okay, so actual results, all right. And I just want to say this, that actual results will depend on really your specific investments, the returns, and the timing. So none of which are guaranteed. All right. But now let's scale it up. Okay. So let's look at a 5,000 conversion at the peak. All right. Now this position here is worth $5,000. All right. So if you do the math at the 24% bracket, federal bracket, that's what we're talking about here, the tax bill is going to be $1,200. So using the same 8% illustrative assumption, okay, this projects to approximately $34,242 over 25 years. Okay. Um, and it looks like, trust me, the numbers are correct. They're not on screen there, but that's what the amount is at 8% growth over 25 years. All right. All right. Now, that same 5,000 conversion when the market is down 20%, the position's worth $4,000. Okay. Uh, so the tax bill now dropped when you do the 24% off of the lower amount. The tax bill just dropped $960 there. Okay, so you saved, well, dropped to 960. So you saved $240 in taxes. So the projected ending value under the same assumptions is approximately the same. Okay. All right. If you scale it to 10,000 conversion at peak, all right. And really the important points I'm trying to get across in this video is just the concept that when you convert when a market is down, if it's the same amount of shares of a position, it's going to cost you less uh, uh, to do the conversion from a tax perspective. Um, I'll have other videos explaining some other ways to look at Roth conversions, other things maybe to ask yourself in case they're appropriate for you. But let's get back to now looking at the $10,000 conversion at peak. Okay. Let's say the position's worth $10,000 at the peak. The tax bill here at the 24% rate will be $2,400. Okay. Now, the projected value over 25 years, if we use the 8%, again, that amounts to approximately 68,485. Okay. All right. Now, the 10,000 conversion when the market's down 20%, that position is going to be worth $8,000. So now the tax bill drops to 1,920. All right. So in this instance, when the market was down, you saved $480 in federal taxes. Okay. So the full position under these assumptions has the potential to recover inside of your Roth. All right. And remember, tax free. All right. And then the projected ending value is approximately the same. Now, again, these are illustrations. The tax savings numbers are real math. Okay. The growth projections are hypothetical. Your actual results depend on really what your investments actually do. And that part nobody can guarantee. Okay. Uh, so what's the key takeaway here? All right. It's that the market dropping is not a reason to freeze. Okay. I think we have this uh, um, thought that when the markets come down, don't do anything. Don't pay attention to the accounts. Don't look, don't take any action. Just wait for them to recover. All right. All right. There's a school of thought out there that use it as an opportunity. Okay. Every market poses an opportunity. So again, the market dropping is not a reason to freeze. For conversions specifically, okay, it can actually be a better time to act because you're paying taxes on a discounted value. And if the market recovers, that recovery happens inside your Roth account. Okay. So the tax savings in the scenarios we walk through, they're real, all right? The growth projections are hypothetical illustrations, not promises, but the tax calculations are just based on math, okay? Now, is this right for everyone? And it's definitely not, okay? Because again, your tax situation, your income, your timeline, your specific investments, all of that matters, okay? And it can change year to year. So what might not be appropriate in we'll say this year may be appropriate next year. What might not be, right? Vice versa, okay? But a Roth conversion that makes sense for one person is what I'm trying to get at. May not make sense for another, but also it can change as that person's situation changes. Okay, so the tricky part isn't understanding the concept. The tricky part is having really someone watching for these windows and moving when it makes sense, not when it feels comfortable. Okay, um, so I want to be clear before signing off is that this video was for educational purposes only. It's not to be taken as personalized investment tax or legal advice, okay? Roth conversions have real consequences, all right? The investment returns are not guaranteed, all right, and will fluctuate. And then tax laws can change, okay? So before you make any conversion decision, just work with a qualified financial advisor or a tax professional who knows your full financial picture, all right? Now, if this is something you want to walk through for your own situation or you have questions on, you can book a 20-minute virtual with me directly. I'll have a link in the description here, or you can head over to zenfp.com. There's a link over there as well. All right. But with that said, until next time, folks.